Well, good afternoon, everybody. My name is Paul Manning from BDO in TAURANGA, and I'm here to welcome you along to go through various matters in relation to insolvency in the COVID-19 environment. So I want to thank you for taking the effort and the time to attend today. I have quite a bit to go through, so the presentation itself may take about 30 minutes, give or take, and obviously we'll have a question and answer session after that. But if anyone's got any questions as we go through, please just let me know, probably using the chat function. So I hope you can all hear me. If anyone can't, please just send a message. And good afternoon, everybody. My name is Paul Manning from BDO in TAURANGA. I'm one of the shareholder directors, and I'm delighted to welcome you all along today, this afternoon. I hope you can all hear me nice and clearly. If not, please just let me know. And if you do want to interact during the course of the presentation, probably the easiest way to go about it would be through the chat function. I have quite a bit of information to get through. Happy to take questions as we go through. Otherwise, we'll have a question and answer session afterwards. So let's get underway. That's what I look like. Clearly face made for radio, but I am one of the partners at BDO in TAURANGA. Have a lot of experience in business turnaround and insolvency, as well as corporate finance functions as well. So that's me in person about BDO TAURANGA as a firm. BDO has been in New Zealand since 1979. Here in TAURANGA, we have a team of 44. Most of us in the TAURANGA office, with a few in our Te Puke office. And we have a very vastly experienced insolvency team. So business turnaround and insolvency is one of our areas of expertise and one of our unique selling points here in the local market. And we actually have 2 accredited insolvency practitioners within our team, being myself and one of my colleagues. So a lot of experience, and obviously going into a post-COVID-19 environment, we expect that a lot of people will need some assistance. So in relation to company insolvency, there are a number of words and definitions that I'd like to go through and give you a bit of an overview of what it's all about, and explain some of the differences between the various phrases or names, because oftentimes people do get confused. So a liquidation. So a company gets liquidated, which means basically the company is formally wound up, and that's it, it's gone forever. So how are liquidators appointed? Well, most of the time, liquidators are appointed by the shareholders of the company. If a company is struggling to make payments to creditors as they fall due, if a company is operating at a loss and every day they open the doors, they're getting further and further behind, well, the way to stop the financial bleeding is to appoint a liquidator. So shareholders usually appoint the liquidators. Otherwise, if a supplier or a creditor is unhappy with a company who has not paid their debts, they can apply to the court, and with that they can actually apply to put the company into liquidation, and they often get the opportunity then to actually name who they would like to appoint as to be liquidator of that company. So the liquidator's duty is to act in the best interests of all stakeholders. So anybody who's owed money is basically a stakeholder, and all stakeholders have to be looked after in a fair and transparent manner by the liquidator. So often when a company's in liquidation, and it's particularly in an insolvent liquidation, the assets of the company are worth less than the liabilities. And so there is a shortfall, and that's where there's often a lot of angst, because there's not enough money to pay everybody out. So the liquidator's job is to realize the assets of the company as best he can for as much as he can. And obviously with a liquidation, once people hear liquidation sale, people are expecting a bargain. So ultimately the value of the assets, because of the stigma of a liquidation, often goes down. So that doesn't make it any easier for the liquidator. So the priority as to what creditors get paid out of what funds are set out specifically in the Companies Act 1993. So often people get annoyed with the liquidator because they haven't received payment or only partial payment and they feel they should be paid everything out. The liquidator doesn't have any choice in the matter. It's the Companies Act who dictates who gets paid out of what funds and the realization out of what assets. So a receivership, what's the difference between a receivership and a liquidation? Well, a receiver gets appointed by a particular party, such as a bank, or it could be a franchise holder. And whereas the liquidator is, his tasks and duties are set out by the Companies Act 1993, the receiver refers to the Receiverships Act 1993. So oftentimes there's a general security agreement in place over the company, and that's basically a charge over all the assets of that company by a bank or a franchise or similar, could be a shareholder. And often that agreement gives the right of that party to appoint a receiver in certain events, which may include an insolvency event or an inability to pay a debt as it falls due. So a liquidator is responsible for looking after the best interests of all stakeholders, whereas for a receivership, the receiver is looking after the best interests of the person who appointed him only. So at the end of a receivership, you might find that the company has no assets left, no cash left, but a whole lot of creditors who haven't been paid out. And it could be suppliers, it could be the IRD, it could be the landlord. The receiver isn't concerned about that. The receiver is only concerned about the best interests of the person who appointed them. He does not pay out any money to unsecured creditors. So what does the receiver do when he's finished his task as receiver? Basically retires as receiver and then hands the company back to the owners. So the owners are then left with a company with no assets and a whole load of liabilities and very unhappy unsecured creditors who haven't been paid, and indeed some preferential creditors who haven't been paid. So what are the options available to the owners at that stage? Well, they're very, very limited. Usually a liquidator would then be appointed to actually formally wind up the company. It's got no reason to carry on. It's got no assets. It's got a whole lot of unpaid creditors who are not going to be paid. So it puts the owners of the company in a very tight spot. But that's not the receiver's concern. That's for the business owner or the company owner to deal with separately. So it is possible for a company to be in receivership, then into liquidation, or sometimes you find a liquidator is appointed and maybe one of the parties who are owed money, who have a general security agreement, aren't happy with the choice of the liquidator or want to make sure that their best interests only are served, and so may appoint a receiver over the top of the liquidator. So a company can be both in receivership and liquidation at the same time. So business turnaround, I mean, once we end up in a receivership or a liquidation event, it's usually it's a terminal event for the company itself. So obviously it makes a whole lot of sense to see if there's any way that the business may be viable. So pre-COVID-19, there was a lot of businesses that were actually viable. The economy was softening a bit, and I think quite a few businesses were feeling the effects of that. But that's not to say they couldn't have tightened their belt or made a few changes or look at their structure and go forward and survive quite easily. But COVID-19 has obviously put a spanner in the works with that. So we have to try and establish, is a business actually viable? And if the answer is no, then need to refer to the previous slides regarding receiverships and liquidations. But if there's potential that the business might be able to survive or has a reasonable chance, we need to define how it might actually be viable. You know, has the market changed? Do we need the same staff? Do we need smaller staff number? Do we need a different mix of staff at different levels of seniority and skills? Do we need to change the operations somewhat? You know, in other words, we can't just say, believe the business is viable. We need to nut out how it might be viable. Obviously, a good starting point is, was it viable before coronavirus? And if the answer is no, well, you know, it would be hard for most businesses to be viable afterwards. One of the things we need to consider is, if a business may be viable, does it just need more capital? Does it need some cash to get it through the short term until it gets back to normal trading conditions, whatever they may look like? And then in terms of the capital, does it need debt or does it need equity? Now, obviously, too much debt in a balance sheet isn't healthy for a company, and still got all the servicing requirements. And even if it's interest only lending for a period of time, it will only become a matter of time before the interest only changes to principal plus interest. And obviously, the business owner needs to be confident that they that they have a reasonable chance of paying back the loan as well as paying the interest in the meantime. Whereas equity finance is obviously getting another shareholder in, or the existing shareholders putting more money in through share capital of the company. For a business to be viable, when we return to level 2 and below, and even in the current level 3 environment, we will need the support of all the key stakeholders, such as the bank, IRD, landlords. We've seen a lot of talk about rent abatement and discussions going between tenant and landlord, suppliers and staff, because obviously staff have been affected as well. Many staff may be on reduced hours and reduced pay, etc. And for a business to be able to survive in the short term so they can thrive in the longer term, we obviously need the support of those key stakeholders. So one of the key messages I'd like to give across is that we need the support of these stakeholders, and the only way that stakeholders will remain engaged and supportive is if we communicate openly, honestly, transparently, and on a timely basis. Most stakeholders will ask on what basis they should support the business. And for that, we probably need in our own minds to work through some really, really hard-nosed projections regarding what we expect to sell over the next 12 months and beyond, what the cost of sales might be, what profit would spit out at the end, and what the effect on the cash flow would be. So you know, when the economy was flying, there was a lot of companies experiencing a whole lot of growth in sales, etc. But you've got to be able to finance that. And in the current environment, we've also got to make sure that we've got enough cash and cash facilities, whether that's lending or additional equity or whatever it is, to make sure that we can actually pay our bills as they fall due, keep our stakeholders engaged so that they'll continue to support us, and make sure that the business actually can survive going forward. Oftentimes when a business is in trouble, shareholders or directors are often a little bit optimistic as to what they might be able to do in terms of trading and profits. Oftentimes we need, with these hard-nosed projections, to look at a best case, worst case, and expected case. And in the current environment, all I can say is I would highly recommend that all business owners engage a team of specialist professionals who can help them to actually define whether or not the business may be viable, how it may be viable, and what support we need in that regard. So I'm going to go through some of the options available if a company or business is in quite severe financial distress, but looking at options that do not involve liquidation or receivership. So giving the business an opportunity to fight another day, if you like. So a voluntary administration, there's an independent specialist, insolvency specialist, who is basically asked by the directors and appointed by the directors to be the administrator of a company. And the reason directors may do this is to basically see if we can get a better return for creditors than liquidating the company or maximizing the chances of the company being able to trade out of its current predicament. Again, avoiding the need for liquidation. The administrator needs to obviously get the buy-in of creditors, because if people don't buy into the administration, then it's never going to work. So after 8 working days, the administrator holds a meeting with creditors outlining the plan. And then after 25 working days, there's a watershed meeting for creditors where they either agree or don't agree on a deed of company arrangement whereby some of the debt may be parked to the side, some may be reduced, there may be a payment plan. All those kind of options are discussed and agreed. There aren't that many voluntary administrations that actually occur in New Zealand. And one of the reasons for that is that for a voluntary administration, the creditors basically have to agree that they've all got the same status in terms of payments, who gets paid out of what, and it involves preferential creditors such as IRD and relinquishing their preferential status down to, say, the unsecured status of other suppliers, and they're often not willing to do that, which you can understand. But often, if they're owed an awful lot of money, they can be one of the parties that say, well, actually, we don't support a voluntary administration and we don't get enough votes to get it through, in which case need to look at a plan B. The creditor compromise can be either formal, which would be legally binding by the court, or informal. And again, it's a proposal which would try and avoid a liquidation process. An informal creditor's compromise is a cheaper option and easier to carry out because there's less formalities to it. But because it's not legally binding, the risk with an informal compromise is that creditors may subsequently turn around and say, no, we're no longer interested in supporting this. Now we're going to go ahead and apply to liquidate the company or whatever. Whereas if there's a formal binding compromise, creditors who are bound by it are not able to change their mind. So a compromise manager, again, someone who specializes in insolvency, would be appointed, and a formal plan for the compromise would be developed for creditors to consider, and the creditors would need to vote on that, need over 50% of the creditors and 75% of monetary value as a minimum. So if we had 100 creditors of $1 each, that makes $100, 100 creditors. For this compromise to go through, we'd actually need at least 75% or 75 of those creditors to agree to it to make up the 75% of monetary value. The compromise has to be fair to creditors and classes of creditors, and once approved, the compromise is binding, legally binding, on all creditors who've received notice. Otherwise, a creditor can apply to the court to have the compromise terminated. And that's why it's so important, if considering a creditor's compromise, that we have accurate information as to who the creditors are, that we know exactly who the creditors are, who all the creditors are, and how much money they are owed. So, how do you define the solvency and the solvency test under the Companies Act? So the Companies Act 1993 says for a company to be insolvent, it has to be unable to pay its debts as they fall due. So if your rent is due on the 1st of the month, you need to be able to pay your rent on the 1st of the month. And the assets worth less than the liabilities. So that's a balance sheet test. If the assets are worth less than the liabilities at a point in time, then the company is technically insolvent under the Companies Act 1993. Now, what we often see, particularly in the SME space, is that included on the balance sheet of a company is the goodwill, and it's usually the goodwill figure that the business owner paid when they purchased the business. So if somebody buys a business that's very profitable, they're going to pay a fair amount for goodwill, most likely. If that business subsequently gets into trading difficulty, starts generating losses, is under cash flow problems, all that kind of stuff, well, you've got to seriously question what the value of that goodwill is. And if a company is not trading well at all, the goodwill could be down to zero. So zero goodwill. So if you're looking at a balance sheet of a company, you got to make an assessment as to whether or not there is actually any goodwill, or if there is any goodwill appropriate in that balance sheet. And that can often be the difference between a company being technically deemed to be solvent versus insolvent, if we're looking at the balance sheet test. So that's a really key thing to look at. You've got to be professionally skeptical, I suppose, in the value of the goodwill, particularly where it's based on a historical figure, which may be no longer relevant in the current environment. So directors' duties. A director, under the Companies Act 1993, the director's duties include to act in good faith and in the company's best interests. So in the best interest of the company, not in the best interest of the director. The directors must exercise due care, diligence, and skill, exercise their powers for a proper purpose, avoid reckless trading, comply with all relevant legislation and the company's constitution, and disclose conflicts of interest. So in terms of reckless trading, how would we define reckless trading? Well, a director must not agree to or cause the business to be carried on in a manner which is likely to increase a substantial risk of serious loss to creditors. And in relation to obligations, when a director is signing a contract or entering into an obligation, the director must believe on reasonable grounds that the company can make this obligation when required to do so. So directors are allowed to make mistakes, you know, and hindsight's a wonderful tool. It's easy to say after the event why someone should have made a particular decision or a different course of action or whatever. But directors don't have a crystal ball, so they can make mistakes or make business decisions that don't work out, but just can't be reckless. Got to be acting in good faith. And oftentimes it's appropriate for directors to seek specialist advice before making some of those decisions, particularly if they're quite complex or need the expertise of someone who's not sitting around the table at the board of directors. So the proposed changes to the insolvency law amidst COVID-19, one of the key proposed changes, and it's a bill going to Parliament soon, but one of the key changes would be that a safe harbour is defined for reckless trading and the obligations provisions that we just discussed. So for this safe harbour, there's a recognition that most businesses will have a significant liquidity problem over the next 6 months, and that's due to coronavirus. The company should have been able to pay its debts as they fell due on 31 December 2019, so that the company was solvent on 31 December 2019, and the directors of the company believe that the company will be able to pay its debts when they fall due, like they were previously, within 18 months now. So that's the safe harbor for directors being able to say, well, actually, we're not reckless trading. You know, coronavirus has hit us like a hammer. This is what we believe to be the case in which we can continue to trade our business. So the business debt hibernation scheme is basically a moratorium on the enforcement of debts. So it's giving business owners an opportunity, buying some time, if you like, to pay off their debts, because obviously not being able to operate for a period of time has had a serious effect on cash flow. So this is a completely new idea. This isn't an add-on to something that's been in operation in the past. It's completely new and novel. And it's basically putting the business debts and that were there at the time of the lockdown into hibernation until the business can get back on its feet, basically. So with a voluntary administration or a creditor's compromise, there was an external third party overseeing the entire process, being the administrator or the compromise manager. But with this business debt hibernation regime, you don't need to appoint an external party to do that. So the business owners can oversee the hibernation scheme itself or regime itself throughout the scheme. However, would recommend that all business owners do seek specialist professional advice at the start of the process, just to make sure that it's set up properly and that it has a reasonable chance of actually succeeding for the business owner. So the threshold on which business owners can apply for the hibernation has yet to be fully defined, but it's thought to be, based on noises from Wellington, that the company must have been solvent prior to the onslaught of coronavirus. So if the business was insolvent before then, this debt hibernation scheme is not available, or I think there would be serious implications for business owners who applied for this hibernation regime at a time, you know, when they were actually insolvent pre-coronavirus. So the directors need to have a prospect of returning to normal trading, right? A reasonable prospect it's not pie in the sky, but that there is actually the core of a good business ahead. And the hibernation of the debts has to be in the best interest of the company and the creditors, so that creditors can expect that they will get paid in due course. So if the threshold is met, the moratorium would be for 6 months. And so the directors would formally notify the creditors seeking this 6-month moratorium. And I believe the Companies Office website either has a template or will have a template where directors can actually use that as the basis for notifying creditors. So that notice gives 1 month moratorium for the pre-existing debts. So that gives the business owner basically a month to come to the creditors with the regime and saying, this is the debt hibernation regime I'm proposing. This is how it would work. This is how people will get paid, when they will get paid. Creditors obviously have to vote on that. And so 50% of the creditors as a minimum, both in number and value, must agree. So if there are 100 creditors, all owed $1 each, at least 50 of them must agree for the regime to be passed. But if the creditors, or if only 49 of those creditors agree and 51 do not agree, then the business owners need to look at other options, such as the creditors compromise, voluntary administration. And if that's not available, then may need to look at liquidation or whatever. All right, so in terms of the new tax support for businesses, one of the key areas that the government has mooted is in relation to a tax loss carryback from 2021 to 2020. So if a company has had a good year of trading for the year ended 31 March 2020 and has paid provisional tax, and then all of a sudden coronavirus means that the company's going to operate at a loss for the year ending 31 March 2021, then the loss for 2021 technically can be offset against the profit for 2020. And so the net effect is there could be an IRD refund for the taxpayer. So this does not affect residential rentals, but most trading companies, this tax support is available, the tax loss carryback. Another key area that the government has looked at is in terms of shareholder continuity. And so what the government are basically saying is that we don't believe that debt finance is the right answer for a lot of businesses, particularly where there's already debt in the balance sheet. So if a company needs additional finance, we would like to encourage them to look at equity finance in other shareholders. So either existing shareholders putting more money in the business through share capital, or other new shareholders coming into the company as shareholders and adding money, which is then available to allow the business to trade. So in the past, IRD have had a policy or legislation in place where 51% was the cutoff in terms of tax shareholder continuity of 51% for tax losses and imputation credits. And that was basically to stop shareholders buying insolvent companies or looking for areas to avoid tax payments to IRD. So what the government are now saying is, hey, we think equity finance is a really good idea for some New Zealand businesses right now. So in order to make it more attractive to get equity finance in the door for these businesses, we're going to put this shareholder continuity rule to the side, so you don't have to worry about it. And that way, if the new shareholders come in and a dividend is subsequently declared, well, the imputation credits are still available to the new shareholders, whereas in the past they would have been gone. And similarly, if the company has got tax losses, but as a reasonable opportunity going forward, we want to encourage new shareholders to back that business. And so we don't want that company to lose tax losses. So making it easier and trying to encourage equity investment rather than just people looking at debt finance. So one of the other matters to discuss is the low-cost assets, which has been increased now to 5,000 plus GST. It used to be 500, so it's a big jump. Depreciation on buildings is now available for the current tax year, being 31 March 2021. And we have found that IRD have been very accommodating for clients who have approached them and said, hey, we're really struggling for cash flow because of COVID-19 and the lockdown period. How about we put an installment arrangement in place? So IRD are very mindful of trying to get businesses back on track. So the finance guarantee scheme for distressed businesses. So these are businesses that are in a distressed state because of the impact of COVID-19. They obviously have to be New Zealand-based businesses, turnover of up to 80 million, maximum loan of 500,000, and to be repaid within 3 years. But there are some fishhooks that we need to be aware of in relation to this scheme. Business needs to use its existing facilities and equity first before being able to use this finance loan. Only 5% of the funds that are borrowed are available for capital expenditure. So at least 95% of the funds have to be used for operations of the business. This isn't a lolly scramble. There are lending criteria, and banks may seek security and may seek personal guarantees from the business owners. So the government have guaranteed 80% of the loan, but the onus is on the bank to collect that money from the business owner first and foremost. So I think when this was first mooted or got into the press, there wasn't much detail, and I think people thought it might have been a bit of a free-for-all, but that doesn't seem to be the case at all. So in terms of the government loans, I think the government made mention of the fact that not enough loans were available for small businesses in New Zealand. So they have come out very recently with these government loan packages where the business owner has to formally declare that the business is viable. It's got the same criteria as the wage subsidy. It's for businesses with a maximum of 50 employees. So the base loan is 10,000, and then you can also go for 1,800 per full-time employee. So if you've got 50 employees, multiplied by 1,800, that comes to $90,000 plus the 10,000 equals 100,000 being the maximum loan available. Again, you got to prove that your revenue fell due to COVID-19 by a minimum of 30%. If the loan is repaid within a year, it's an interest-free loan. But after a year, if you can't pay it back, then there's 3% interest, and the loan is available for a maximum of 5 years. But you only got to start making repayments on the loan after 2 years. So you might have a year interest only. So we're coming to the end of my half an hour, and then I'm hoping that we'll have some interaction in terms of questions and answers. But one thing, a couple of things I just want to point out before I hand over to the floor and to the questions is if we enter into a payment arrangement with anybody, whether it's the IRD, whether it's an informal creditor's compromise, voluntary administration, or whatever it is, the payment arrangement has to be honored. So by entering into a payment arrangement, all we're doing is altering the time frame for the payment of that debt. We're not altering the debt. So it's not a gift, it's a debt, and it needs to be paid. A lot of the time we meet people when it's too late. At BDO, our insolvency team, we often meet people and we always leave an initial meeting and thinking, God, if we had met you 18 months ago, we could have done so much more to help you. You may have had more levers to pull or more options. So all I will say is I really recommend that people seek specialist professional advice on a timely basis. I am, and one of my colleagues is an accredited insolvency practitioner. And so we are members of RETANS. And with that comes a code of ethics, similar to the code of ethics for the Institute of Chartered Accountants and the New Zealand Law Society. So if you are dealing with an accredited insolvency practitioner in any dealings whatsoever, you should have comfort in the fact that we are part of an organization and we do uphold that code of ethics. And any breaches of that code are severely dealt with. So I think it's really, really important in the current environment that people deal with people with the right qualifications, with the right experience, and members of RETANS. RETANs, and prior to that there was other bodies under different names and guises, have been applying and really trying to put pressure on various governments for the last 10 years regarding making insolvency practitioners licensed. So if you want to do insolvency work, you have to be a licensed practitioner. That law was meant to come into place on the 17th of June next month, after 10 years. And the government are now, or MBIE, are now talking about possibly postponing that. We are not in favour of the postponement whatsoever. As I said, we want people to deal with people with the right credentials, qualifications, and the code of ethic that goes with it. So we think that's bad news. What we don't want is a whole lot of cowboys entering into the insolvency profession just because businesses are struggling. I think it's for the best for the New Zealand economy that people deal with people who have actually got the experience and skills and qualifications required. So I would ask that you guys bear that in mind in due course. Now, does anybody have any questions? I hope I haven't gone on too long. I thought my presentation was meant to take about 30 minutes and it's taken about 35. So that's not too bad, but we do have plenty of time for questions. Does anybody have any? I can't see any coming up on my screen. I hope I haven't put you guys all to sleep. We have recorded this meeting or this presentation, and it will be available from the BDO website and probably through the chamber as well. And I'm sure if anybody wants to get hold of me, you're most welcome to do so. Paul Manning at BDO here in TAURANGA, paul.manning@bdo.co.nz. And once again, I just want to say thank you for attending and wish you all the best going forward. If you've got any queries over the next number of months, just give me a call. Look forward to talking to you soon. Thank you.
Thank you, Paul, on behalf of the Chamber.
No problem at all. I haven't seen any questions, so unless you have, Jeanette, I think we'll just leave it there.
All good, and I will be sending a follow-up feedback to all the participants as well, and there'll be some information on that around and further support from our Chamber Regional Business Partner team if anyone needs that as well. So thank you everyone for attending.